Intro music, ominous, driving beat with quick cuts of stock tickers, corporate logos, then a sudden crash sound effect. Host, energetic, slightly cynical Enron. The name still sends shivers down the spines of anyone who lived through the early 2000s. A company that was once the darling of Wall Street, a beacon of innovation, a supposed glimpse into the future of energy, vanished almost overnight. How did a corporation valued at $70 billion become synonymous with fraud, greed, and total collapse? Simple. They built an empire on an elaborate lie, fooling everyone from Main Street investors to the most seasoned financial analysts. And today, we're tearing down that façade. Graphic, Enron, the rise. Host asterisk in the 1990s, Enron wasn't just big, it was the company. Founded by Ken Lay in 1985, it started as a natural gas pipeline business. But Lay, along with his visionary CEO, Jeff Skilling, had bigger, bolder, and ultimately, far more dangerous ideas. They saw deregulation coming and transformed Enron into an energy trading powerhouse. They traded everything, gas, electricity, even bandwidth for fiber optics. Enron wasn't just selling energy, it was creating markets, innovating, making deals that seemed almost too good to be true. Graphic, Jeff Skilling's vision, mark-to-market accounting. Host asterisk Skilling's big move. Mark-to-market accounting. Sounds boring, right? But this was their first weapon of mass deception. Traditionally, a company books revenue when a project is completed and paid for. Simple. But mark-to-market allowed Enron to book potential future profits from long-term contracts immediately on their financial statements. Imagine selling a house today, but booking the profit you hope to make on it 10 years from now. Sounds insane. It was. It made Enron's earnings look fantastic, painting a picture of explosive, consistent growth. Graphic, the illusion of profit. Host asterisk Wall Street loved it. Enron's stock price soared from around $20 in the mid-90s to over $90 by 2000. They were named America's Most Innovative Company by Fortune magazine for 6 consecutive years. Ken Lay, Jeff Skilling, they were corporate rock stars, gracing magazine covers, preaching a gospel of free markets and limitless growth. But beneath this glittering facade, the company was hemorrhaging cash. Their actual operations weren't generating enough money to cover their expenses, let alone their wildly inflated profits. Graphic, Andrew Fastow and the SPVs, hiding the debt. Host asterisk This is where the real villain of the story steps in, Andrew Fastow, Enron's CFO. Skilling's accounting tricks made profits look good, but what about the losses and the mountain of debt Enron was accumulating from its risky ventures? Fastow had a brilliant, evil solution, special purpose vehicles, or SPVs. Animation, a complex web of arrows leading from Enron to many smaller, shadowy corporate entities. Host asterisk Think of SPVs as shell companies. Enron would sell its underperforming assets, its failing power plants, its money-losing ventures, or its huge debts to these SPVs. On paper, it looked like Enron was offloading bad assets. But here's the kicker, these SPVs were secretly controlled by Enron itself, often funded by Enron's own stock, and sometimes even personally managed by Fastow and his associates who raked in millions in management fees. It was like shifting furniture in a burning house, pretending you'd sold it to someone else, but still secretly owning the burning house and paying for it. Host asterisk This allowed Enron to keep billions of dollars in debt and massive losses off its balance sheet, creating an entirely fabricated financial reality. They were literally using these shadowy entities to make their debt disappear and their losses vanish into thin air, all while their publicly reported earnings continued to skyrocket. Fastow even pushed the envelopes with Raptor transactions, designed specifically to absorb losses that were too big for other SPVs. Graphic, the auditor's complicity, Arthur Andersen. Host asterisk And what about their auditors, Arthur Andersen? One of the Big Five accounting firms. They weren't just turning a blind eye, they were complicit. They signed off on these fraudulent financial statements, often helping Enron structure the very deals that were designed to deceive. When the scandal started to unravel, Andersen employees were caught shredding thousands of documents related to Enron. Their reputation, built over decades, was destroyed almost overnight, leading to the firm's ultimate demise. Graphic, the cracks appear. Post asterisk, but even the most elaborate lies eventually crumble. By late 2000, cracks began to show. The sheer volume of hidden debt and artificial profits became unsustainable. Enron stock, once unstoppable, started to falter. Internal whistleblower Sharon Watkins sent a memo to Ken Lay warning him of potential accounting scandals, stating, "We are a house of cards." She was ignored. Post-asterisk analysts, who had been dazzled by Enron's numbers for years, finally started asking tougher questions about the murky SPV deals. Then, in October 2001, the dam broke. Enron announced it would have to restate its earnings from 1997 to 2001, reducing reported income by over $500 million. The market panicked. Its credit rating plummeted. And just like that, the illusion shattered. Graphic, the collapse, December 2, 2001. Post-asterisk on December 2, 2001, Enron filed for Chapter 11 bankruptcy, the largest in U.S. history at the time. Thousands of employees, many of whom had invested their life savings, their 401ks, entirely in Enron stock, lost everything. Retirees saw their pensions wiped out. Their faith, and their financial futures, evaporated with the company. Graphic, justice and consequences. Post-asterisk, the fallout was immense. Ken Lay, Jeff Skilling, and Andrew Fastow were all indicted. Lay, unfortunately for justice, died before sentencing. Skilling was convicted of fraud and insider trading, serving over 12 years in prison. Fastow, after cooperating with prosecutors, served 6 years. Arthur Andersen, as we mentioned, effectively ceased to exist. Post-asterisk, the Enron scandal, alongside others like WorldCom and Tyco, sent shockwaves through the corporate world, leading directly to the Sarbanes-Oxley Act of 2002. This landmark legislation aimed to prevent future corporate fraud by increasing accountability for executives and auditors, demanding greater transparency, and introducing harsher penalties for financial crimes. Graphic, lessons learned. Post-asterisk, Enron didn't just collapse, it imploded under the weight of its own lies, leaving behind a crater of mistrust and forever changing how we look at corporate America. It's a stark reminder that if something seems too good to be true, if the numbers don't quite add up, or if innovation seems to be code for, "We don't want you looking too closely," then maybe, just maybe, an empire built on deception is about to come crashing down. Post-asterisk, what do you remember about Enron? Were you affected by the scandal? Let us know in the comments below. If you found this deep dive into corporate greed fascinating, hit that like button, subscribe for more untold stories of business scandals, and ring that notification bell so you don't miss our next exposé. Outro music returns, slightly more hopeful or reflective, with channel branding.